spot market, so foreign exchange spot market, so T+2 settle. That is a purely, in my opinion, supply and demand driven market. There's really, there's liquidity. You can change your mind at a given time for a relatively low cost, and it is actually it's almost a perfectly functioning market. Now, what are the drivers of the supply and demand? Those could be basically interest rate expectations. They could be political news and everything else. However, the foreign exchange market is simply a clearer of supply and demand, and is essentially a function of supply and demand. To actually get the foreign exchange market correct, you don't need to sort of know about some political scandal or something else. You just need to think, are there going to be more buyers or sellers today? And that's all the answer really is. And it sounds overly simplistic or anything else, but that's really all there is. And you can get a good idea of where it's going to go by looking at graphs, because now why is looking at a graph or a technical chart good? Well, the only reason why it actually works is because other guys are looking at it, and it's a self-fulfilling prophecy. So have all these guys who know all these reversion theories and everything else and technical resistance and this and that, but in reality it's only because there's a lot of other guys who also know the same thing that you're looking at and think, okay, here, I'll buy. Now, even though sort of it may be going down, if enough of your friends are sort of looking at this stuff, and it's not about collusion, but it's just this can be happening completely separate from one another, but there could be guys sitting at 10 different banks and say, technically this looks like a good level. And if there's more of them buying at one time than actual selling from some real flows, be it sort of an oil company or something else like that, the market will move up. And that's essentially what is the main driver of that. So it is actually very efficient in sort of telling you how badly people want exposure to the country or the currency. Interest rates are I think sort of are driven by two things primarily. One is essentially obviously where the central bank is putting the overnight rate. That is actually influenced a bit by the currency level. So if the currency is very strong, they may try to lower rates in an effort to weaken the currency. The logic is that if we're paying you less interest for your money, you're not going to want to keep your money in South African rand. Therefore, we're going to pay you less, and hopefully, therefore, we will weaken the currency, and therefore, we will become more competitive on an export basis, right? So therefore, we can actually see the real economy will actually grow as opposed to fast money or just sort of financial inflows. So yeah, that's how I think sort of interest rates essentially can influence the FX, and then interest rates on their own sort of that's the one driver is the central bank rate, and then forward expectations of the rate. So the shape of the yield curve is a function of where people think interest rates will be in 1 year's time, 3 years' time, however, and that's how you essentially derive the shape of the curve. Then essentially what you've also got, the other driver of interest rates are yields on government bonds. Right? This is theoretically supposed to be risk-free debt, right? Because the guy who prints the currency also effectively sort of issues the debt, so therefore the correlation should be there. So he, in theory, could just basically continue printing currency to pay back the debt. So that this is actually guaranteed, fiduciary. So what you've got with that is you've got there's obviously maturity profile. So the idea is I'm lending money to the government. The longer I lend it, therefore I have to sort of receive more yield, which is the upward slope of the curve. Now, this is also a much more efficient market in some respects as opposed to interest rate swaps, because this is a function of supply and demand. If basically National Treasury is issuing more long-term debt than people want, the curve will be very steep because people are going to demand a higher premium because they know there's more and more coming. This is the situation which we actually have right now. So, obviously sort of foreign inflows like we've seen for the last sort of 2 years, that into those products has obviously helped the currency, has probably kept the currency from selling off as heavily as it has. But I think in terms of the actual overall turnover on a daily basis, it's relatively insignificant. I think if you didn't have these foreign inflows into the bond market, currency would probably be, up 920 or something like that right now. and unfortunately, if they stop, it could be there as well pretty quickly. So we're in a bit of a precarious situation. So that's kind of how. So there is influence and sway over one another. However, though, it's not that neither one is really truly dependent on the other.